And welcome to Raise Your Average. I'm Pierre Daly, managing editor at advisoranalyst.com. My co-host is Mike Philbrick, CEO from Resolve Asset Management Global. Our very special guests today are Darius Dale, founder and CEO at 42 Macro, and Jason Del Vicario, portfolio manager at Hillside Wealth Management. Darius Dale is the founder and CEO of New York-based 42 Macro, an independent investment research firm that aims to disrupt the financial services industry. Prior to founding 42 Macro, Darius was a managing director and partner at Hedgeye Risk Management, a leading independent investment research firm based in Stamford, Connecticut. At Hedgeye, Darius was the sector head of the macro team and was a core contributor to the firm's economic outlook and associated investment strategy views. Jason Del Vicario is a portfolio manager and advisor at Hillside Wealth Management at IA Private Wealth. Having worked in the industry since 1998, he has an exceptional background in discretionary portfolio management with a proven process that has consistently generated superior results. We're going to talk all about that great stuff today. He's a regular on BNN Bloomberg, and he's also one hell of a swimmer and a polar bear. Jason joins us today as a guest advisor panelist. Before we roll, please hit that subscribe button, like us, leave us comments and ratings because it helps more people like you find us. Please enjoy our conversation.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Darius, Jason, welcome to Raise Your Average. It's wonderful and timely to have you both with us. So much to talk about.
Yeah, thanks for having me.
Looking forward to it.
Did I miss something? No, I love it. I love it. And I'm sure that investors and listeners, other portfolio managers are out there thinking through what the implications are of all of the goings on, from tight financial conditions to inflation, volatility, and dispersion around asset prices and potential outcomes. So I am really keen to hear Jason and Darius's points of view on this, and then also thinking through how portfolio managers, advisors, high net worth individuals can think about the positioning in their portfolios potentially and move incrementally from wherever they are to maybe an approach that incorporates some of the macro goings on in the world to try and meet investors' needs and goals.
Very
and
exciting
objectives.
times, my friend. We were remarking before the show, macro's back. Yeah, we kind of went in hibernation for about 18 months there when the Fed was rapidly expanding its balance sheet. But it seems like when they turn off the light switch, all hell breaks loose. So I'm excited to be with your audience.
So guys, to get things started, why don't you take turns telling us each the stories of your careers and your background, what you're working on these days, your mission. Jason, since it's been, I think, about 4 years since we last had you on, why don't you get things started?
So as you mentioned in the introduction, I've been in the business since 1998. I started right out of university with a bachelor's of science in atmospheric sciences, meteorology, like all good money managers start with. I spent the better part of 15 years producing mediocre results in a sort of a traditional investment advisor role where I was wearing all the hats. However, having said that, my passion has always been, since the age of 15, has always been in security selection and portfolio management. It just took me about 15 years to get to the point where I'm doing, as I am now, basically everything that I want to be doing and as little of the things that I don't want to be doing. So we've taken the approach, which is unique in the Canadian landscape, where we have decided to completely split the roles on our team. So 7 years ago, I got together with my brother-in-law. I said, listen, my vision for a wealth management practice. And by the way, at this point, I was 1 foot out the industry. I'd gone through the tech bubble. I'd gone through 2008. I'd been the 25-year-old going to tell people they need to retire later or with less money. And for me, the interaction with the retail investor was really trying and challenging. And I just wasn't enjoying it anymore. So 2015, I said to my brother-in-law, we both had similar book sizes. I said, why don't we combine forces? I'll focus on the money management and you focus on the client facing financial planning. And let's give this a shot. And my background, so I did eventually get my CFA. I've read every Warren Buffett, Charlie Munger, Joel Greenblatt, Peter Lynch, all of these books. And I knew in my mind what the right way and how the right way was to manage a portfolio. But simply put, because I was doing the financial planning, the estate planning, running the meetings, doing the portfolio management, I just wasn't able to focus as much on that particular task. And that is the task that I'm really passionate about and I enjoy. So 7 years ago, we ripped the Band-Aid off. I basically gave up my book, gave up those personal connections, which of course is really the equity of any sort of financial advisor business. And we both took a leap of faith. Our book has since grown from 60 to 170 million. And our process is very simple. We run concentrated portfolios of high quality, predictable businesses, global high quality, predictable businesses that meet a number of criteria, which you mentioned, Pierre, and we can probably throw around here over the next few minutes or hour. We're very, very picky. I have a fellow in who's actually located in Hong Kong who I've never met. He and I work very closely together, and we're solely responsible for the research and the portfolio management of our side of the practice. I'll just add one more tidbit. I've used all sorts of, I've used all the software. When I was at Canaccord, I used Bloomberg because they paid for the terminal. I've used Google Screens, Yahoo Screens. I've used Morningstar. I've used all of it. And I couldn't find a piece of software that did everything that I wanted it to do in terms of customized metrics, customized screening, and what have you. And so I got together with an industry student project at BCIT. I had 5 engineers assigned to me. And for $500, I built what we call our Hillside Factory app. And basically this app is wonderful. It integrates with the API at Guru Focus, which I think is really the best data source on the internet for financial data. And it is a tremendous help in terms of doing our analytical work. We also believe in speaking with management, IR and management of companies that we are interested in or do own. And so in a nutshell, that's our process. I'm having a lot of fun. I can certainly say that this year it's a lot easier. So not only are we focused on quality predictability, but we also have a very strong value discipline. So we use a hurdle rate of 20%, which I realize is high. And you can imagine that last year, finding anything that would meet a 20% hurdle rate was like we were just tearing our hair out. So this year, we're finally finding some value. While our clients aren't thrilled that they're down, whatever it is, 15% on the year, we're quite pleased because we've got more opportunities in front of us. So I hope I didn't take up too much time there, but that gives you an overview of what we're up to.
No, but I think we're going to have a really interesting discussion today.
Yeah, I was going to say we're very we're on polar opposite ends of the spectrum in terms of processes, but obviously I think we're a lot more aligned in terms of being data driven. I think that's one thing that ties us all together here is understanding how to weaponize and wield data and to produce good outcomes for your clients. And so appreciate the background, by the way. I love hearing people's stories. It's always we all kind of have an interesting story in this industry. I certainly have my own. So as I mentioned, I joined this industry back in 2009, kind of at the lows, the depths of the economy, the financial crisis. As an India, I guess I like to chase storms, if you will. Joined a firm called Hedgeye. It was then called Research Hedge, just as a research groupthink powerhouse, a bunch of sort of former buy-side guys who got together and wanted to do a better job of research and obviously what the sell side was putting out. I sort of had kind of a career pivot as well, fairly early on in my career. This is in 2010. I initially started off covering consumer companies, and quite frankly, I hated it. It was so boring. There was all this like cool macro stuff going on. I was reading Zero Hedge, and I'm like, man, I'm not going to read a 10K and put this model together. And so, I finally just said, hey, look, I'm going to go do something else if I can't cover macro. And sort of that's where it all began. For those who are unfamiliar with Hedgeye, it's pretty decent size research firm now. I've sort of, I guess, my contribution to that firm and to the industry was sort of designing and developing their quad process, which is their systematic regime segmentation process that they use to forecast not only the economy, but also help clients with their asset allocation and portfolio construction solutions. So that's kind of my baby there. And eventually I left almost a couple of years ago now, to start 42 Macro. I figured I could, there's some things that I want to improve on, do better, do differently. And ultimately it's been a great experience thus far, and great experiment, if you will, because, we certainly built, quite a big audience in a pretty small amount of time. But also, we're delivering some pretty fantastic results for our clients as well. We run a very sophisticated portfolio construction process that many of our sort of retail and high net worth subscribers follow along with, and that's up about percent year to date, 4% year over year, which obviously relative to most things in the broader market, most the balanced portfolios are obviously down double digits. So I'm proud of that. I'm excited to get to a more calm state where we can start allocating money to work for real and kind of not banging my head on the table for 100 basis points of return. But it is what it is. That's kind of the nature of markets these days.
Thanks, Darius. Thanks, Jason. It's nice to hear the varying angles that you're both coming from. And as I said, there's going to be lots to talk about today. I think the recent event, of course, is this Jackson Hole meeting, where the Fed somehow was unexpectedly very hawkish. I mean, I'm comparing that to obviously investor expectations given the run up in the market since June. And, that seemed to have burst the bubble very sharply, very quickly. And Darius, if you want to give it a go, I'm sure you've got some very profound thoughts on what's going on right now, how your framework has, what assessments your framework is throwing out right now in terms of whether or not inflation has peaked. That seems to be quite a discussion right now. And, the Fed doesn't seem to think so. Neither does the ECB. Isabel Schnabel's remarks about the great volatility that's coming, that we're in for a longer period. Agree, disagree?
Oh, 100% agree. Yeah. But doesn't it seem like the ECB policymakers are just taking their cues from the Fed? They're like, well, they got guys that come out and talk every day, so why not us? Yeah, exactly.
They're just like, used to be that they didn't even talk. They just showed up. Totally. It was Alan Greenspan with a briefcase full of notes, and you had to figure out what he was going to do.
Totally, absolutely, man. Yeah, if there was smoke coming out of the Eccles building, it was a rate hike. Yeah. Anyway, I got a few slides, just kind of to answer your question, Pierre, on sort of like what we're thinking from what we're thinking just in terms of inflation peaking. So let me take a step back. Phase one of this, what we've been calling we're in the third phase of this monetary policy regime here in the U.S., and it's sort of extending itself globally, if only through the lens of the currency channel. Phase one of the regime was, sort of from November through June, where the Fed had to effectively catch up to market pricing on policy rates, on tightening expectations, which is born out of the fact that the Fed had a very delayed reaction function to a lot of the inflation pressure because of its erroneous forecasts on transitory. Now, phase two was the market pricing in the response to all the Fed tightening that we've accumulated and are likely to accumulate over the coming quarters, which is a potential downturn in the economy. So clearly the market got, from the lows of June through kind of the highs of mid to late August, market was very comfortable pricing in an eventual dovish Fed pivot, to the tune of, we saw, over, 75 basis points of rate cuts priced into money markets for next year, as a function of this view of the market, taking that, hey, inflation's going to come down, growth's going to come down, and really cause an about face pivot by the Fed. We're now in phase three, in my opinion. Phase three is characterized by the Fed pushing back on that expectation, understanding the lessons of history about pivoting too soon off of these tightening cycles, and ultimately doing what it takes to sort of maintain credibility with the bond market, with investors broadly, that they're going to sort of get the job done on fighting inflation. And so that's sort of where we are today, which is the market's now pricing out a lot of that easing of financial conditions, both in the near term, but also the easing of policy rate expectations that we're going to see in 2023. So just going back to just a few slides on this inflation dynamic, because again, I think there's so much going on. I think volatility is the right word in terms of Isabel Schnabel over the ECB. Volatility is the right word. Whenever you have higher inflation, and this is empirically proven, it's not rocket science saying this, but when the higher inflation you have, the higher volatility, realized volatility of inflation you have. Typically, when you have higher realized volatility of inflation, you have higher realized volatility of real economic output. And as a function of that, this is why the Fed is so concerned about structural inflation expectations, and why their maximum employment mandate is conditional on price stability, because I think they understand everything I just said about, hey, it's really hard to run an economy when you have that much economic volatility as a function of inflation. So this is, in our opinion, this is why we are in phase 3 of the monetary policy regime, as opposed to a runaway phase 2, which I think the markets were very comfortable with, prior to a couple of days ago. So just a few slides on this the entire discussion. So as you mentioned, Pierre, or Mike, we do run a regime segmentation process at 42 Macro. It's designed to understand the trending rates of growth, that'd be the y-axis there, and the trending rates of inflation. And as you can see, the U.S. economy since really July of last year has been in what we call inflation. That's growth trending lower, inflation trending higher. In the month of August, at least according to our projections and nowcasts, we're likely to transition to deflation, where inflation is going to be trending lower and growth is going to be trending higher. Now, that doesn't mean, inflation is solved. We're talking about coming off of a 40-year high and inflation, pick your statistic. So that doesn't necessarily mean things are good, but we have in fact seen quite a few positive developments. And this is why, I think the discussion around inflation is very two-sided at this particular juncture. We've seen this massive deceleration in core inflation momentum in the month of July, where you look at trim mean inflation, median inflation, sticky inflation, trim mean PC inflation, and most importantly, core PC inflation, which is, clearly the Fed's kind of preferred metric that they use to kind of forecast inflation dynamics. I'll skip a few slides and just highlight the breakdown we saw in core PCE inflation on the month over month annualized basis. We slowed 630-ish basis points month over month in the month of July. There's only been 1 month in the history of that time series, going back to the late 1950s, of a sharper slowdown in inflation. And so there is something to be said about the transitory, at least the transitory debate. That narrative is, in my opinion, more probable than it was prior to July. I think, we could wind up in a scenario where both the persistent and transitory camps on inflation are proven right, just at different intervals. And so I think again, as I mentioned, inflation risk is two-sided. We've done a considerable amount of work that suggests that it's very unlikely we see this kind of breakdown sustain itself in the coming months. But if we do see that breakdown sustain itself, then I think we're going to have a very different conversation about what the Fed's reaction function is going to be. But ultimately, I think, again, the most likely scenario is that breakdown does not sustain itself. We sort of trough out around, let's call it 3 to 4% core inflation momentum, and that's going to make the Fed's job a lot harder, than our opinion, than the average investor realizes.
How do you see the growth engine coming back into this, right? Into the sort of, I think you refer to as quad 4. So you have this slowing inflation. I guess my concern is also slowing growth rather than a reacceleration in growth, and moving from an environment where the Fed has been able to add the Fed put, and maybe being more in an environment where it's a Fed covered call, in that the Fed is struggling to deal with the inflationary inputs. And thus, every time that we do get a spurt in growth, that we have this ceiling that we're hitting, sort of like a covered call, putting it in option terms, where you just hit this ceiling constantly. And as growth reignites, inflation reignites in a larger magnitude, and thus causes this sort of Fed reaction function that is very new and different from sort of the last
spot on, man. Absolutely. So I'll say, on the growth side, I think the base case scenario is that we're going to continue to slow. In fact, that's what the model's obviously projecting by projecting deflation. But in terms of the leading indicators for growth, the best leading indicators are usually those in terms of leading indicators, generally speaking, financial markets, survey data, or, kind of in that order. And when you look at financial markets, one thing we track the shocks that we observe in different segments of the economy, different sectors of the economy, through the interest rate front. And when you look at real interest rates, we're having like a +2x, in excess of +2 sigma shock on a trailing 3-year Z-SOR basis for real interest rates, historically speaking, as denoted by these dotted lines in this chart here. Historically, you see a pretty significant slowdown that is quite persistent from those shocks, typically 12 to 18 months of economic deterioration from those levels. And so we only recently reached the 2 sigma threshold in this analysis on real interest rates. Similar setup with mortgage rates. I think we got to a 2 sigma plus, actually we got to 3 sigma plus in mortgage rates a couple of months ago. So that's going to have that's already having a real negative implication in the housing sector. It's basically in recession now. And then you talk about this through the lens of corporate borrowing costs. So when you look at those 3 indicators from a leading indicator perspective, you're talking about an economic slowdown that should persist at least through the middle of next year. At the bare minimum, the middle of next year, at least according to the historical data. But the one thing I will say on the other side of all that is that this is an economy that is very different than the economy we're sort of used to. This is an economy that's growing gangbusters from the perspective of the labor market. In fact, the labor market is in fact overheating by double, at least when you look at it in U.S. terms and rate of change terms. So what I'm showing in this analysis here is the 2015 to 19 trend, the pre-COVID trend of these various metrics: private payrolls growth, private sector average hourly earnings, average weekly hours, and ultimately the product of all that, which is aggregate labor income. But you look at 3.7% on a 3-month annualized basis. That's more than double where we were in the pre-COVID period, more than double, basically double where we were in private sector average hourly earnings. Corporations are flexing their kind of margin pressure, or they're flexing weekly hours to alleviate some margin pressure, but ultimately not flexing it enough because, again, you have aggregate labor income that's growing at 8.3% on a 3-month annualized basis. And that's, it's more than double what we're talking about from a pre-COVID perspective. So the key takeaway is that when you look at consumer balance sheets and when you look at the health of the labor market, this is obviously the labor market here. When you look at consumer balance sheets, with household debt being well off, recent highs and trending lower, this is a different economy. I think we have to acknowledge the fact that 2.5% on the policy rate might have been neutral in 2018. In fact, Powell called it out as neutral in 2018. In this economy, it's probably not neutral, and the Fed is probably not anywhere close to being restrictive. And so ultimately, I think the yield curve is probably correct in its assessment that, where, recession risk is not legit. It's not a legitimate modal outcome at this particular point. And what I mean by that is that the 10-year 3-month has yet to invert, and historically that's the actual signal to put the countdown on a recession clock. So it's a tricky economy, man. This is an economy that has got more juice to the growth side than I think a lot of us anticipated, at least certainly most of the market anticipated a couple of months ago. But it's also an economy with a lot more inflation dynamism and volatility that might make the Fed's job, more challenging over the next kind of 6 to 12 months. So how that shakes out in asset market terms, we could talk about how to construct a portfolio in that regard, but I think we'll save that for a later part of the discussion.
Darius, sorry, just a quick question, Darius.
Yeah,
I think talking about labor, how accurate, to what extent? I guess it's a dual question. How accurate is the claim that there are two job openings for every job being demanded right now, which is causing some inflationary pressure in the labor market or from the labor market? To what extent, like there obviously have been adjustments. I think this is an area worth sort of explaining a little bit, because we, coming out of the pandemic, a lot of people obviously dropped out of the labor market, let's say permanently, according to statisticians. And how did we get to the state where you have such a seemingly artificially driven shortage in the labor market? When I say artificially, I mean because of people's choices, but how does that work?
Yeah, so I'll start by saying, so you're spot on, and I'll elaborate on some of the things you say, but I don't know that the movement in the labor market is artificial. I think there's a couple of things driving it. On the one hand, we have a pretty substantial decline in the labor force participation rate for 55-plus-year-olds. We've obviously seen what had been delayed retirements throughout the kind of the post-crisis era kind of accelerate in mass, and obviously the health scare associated with COVID clearly probably accelerated a decent amount of that. I also happen to think that the household sector balance sheet being strong as it is through the lens of both, through the lens of obviously debt, also on the asset side, you have the number one asset most households own is their house, up 20% year over year after being up, I want to say 12 to 18%, pick your locality last year. So we're having a considerable, I wouldn't necessarily say bubble, but certainly a melt up in the asset side of the household balance sheet. And all that's being reflected in terms of the wealth effect. If you look at the latest data of household net worth relative to disposable personal income, it's about, we're over 8x, 818% to be exact, on that metric. And, that's basically a double of where it peaked out at prior to COVID. And so households are feeling very rich. Yeah. And so in terms of feeling very rich, you're probably seeing a lot of sort of marginal labor force participation that accelerated to being out of the labor market. I use this as an example. For instance, I myself personally, just anecdotally, moved out of the city to upstate New York. And if anyone who's lived in Manhattan understands the difference between your cost of living in Manhattan versus upstate New York is pretty substantial, right? And so, you don't necessarily need a 2-income household in upstate New York in the same way you do in downstate, Westchester, et cetera, et cetera. So I think there's a lot of that going on in the labor market as well, because we're seeing the female labor force participation rate off 100 basis points from its pre-COVID high. So we have a very structurally tight labor market from the perspective of supply in that regard. And so it's ultimately manifesting itself through a pretty considerable amount of higher wages and a lot more sort of confidence and flexibility amongst employees and bargaining power ultimately. So this chart shows the total amount of job openings relative to the total number of unemployed people who are identifying themselves as looking for jobs and unemployed. That's at 1.8x. We're coming off an all-time high there. 3.1%, the private sector quits rate, coming off an all-time high there. That's obviously an indication of confidence. You don't quit your job to get a worse job or a lower paying job. You quit your job because you think the labor market is extremely robust. And then lastly, it's all channeling its way through the wage channel, which is private sector compensation. When you look at total compensation, salaries, benefits, et cetera, that's at 5.5% on a year-over-year basis through the second quarter for private sector. That's an all-time high in this metric. And so again, as I mentioned, this is a labor market that we just have not seen this kind of tautness and this kind of momentum in a really, really long time. And obviously it's contributing to some of the core services-oriented inflation, but some of the goods inflation that we're seeing kind of come out of the time series as a function of the unwind of some of the supply chain disruptions. It's making this a very difficult, volatile, kind of confusing time to analyze, but ultimately we got to just trust the data and let it be our guide.
Are you seeing, so I was talking with Neely Taminga over at Distill on the idea of, this labor market reformation. Are you seeing any sort of productivity alterations? It's very short term, but so you've got this demand for more labor and you've got this sort of changing type of individual that's in the labor market, i.e. Gen Xers and boomers who are kind of workhorses when it comes to work-life balance versus millennials, Gen Z, who are a little bit more focused on work-life balance. And we're hearing this anecdotally through, various, whether it's quiet quitting, this idea that work-life balance. So is it potentially a possibility that as we're experiencing this increase in labor costs, that's got implications for growth and profit margins, obviously through the corporate dynamics and multiples on those types of stocks. But anecdotally, we hear that as Xers and boomers retire, you have to hire sort of 1.25 of this new workforce to bring the same level of productivity. So I'm wondering if both Darius and Jason, are you guys seeing that either bottom up from as you look at corporations or discuss these issues with the managements that be? Jason and Darius, are you seeing any of that sort of productivity issue manifesting in any data? Because it's quite anecdotal at the moment. It's really kind of hard to put a finger on other than
I'll be quick, Jason. I'll let you. I'll toss it over to you. Let me just be real quick here because I've been hogging the mic here. But so the answer it's in the data. So we're seeing productivity. If you look at on a year-over-year rate of change basis, we had an all-time low in that time series at minus 2.5%. So this is, in terms of growth rate, this is as unproductive as the U.S. economy we've ever seen. So there's definitely, it's a little bit more than anecdotal at this point. I would tend to agree that there is a significant sort of fundamental shift in the labor market through the lens of, transitioning from baby boomers and particularly Gen Xers. I mean, Gen Xers and millennials couldn't be further apart in terms of, their outlook on labor and kind of, and dealing with all that. And as a function of this sort of, you mentioned it, Mike, this 1.25 kind of replacement cycle, it's showing up in unit labor costs at 9.5% year over year, which is the highest number we've seen since going back to the mid 80s. So yes, the labor market is so tight that it's now starting to kind of cause problems for corporates. And you're finally starting to see corporate operating margins, whether you look at S&P or operating margins, or you look at corporate profits as a percentage of GDP, we're now rolling off what, I would consider to be some fairly unsustainable highs, particularly in the context of a Fed that seems to be hell-bent on reducing nominal GDP.
All right, I'll weigh in. So how do I put this? I am interested in macro from a sort of a personal perspective. I have all sorts of opinions and views. I have an opinion of where I think inflation is going and interest rates and so on and so forth. But the reality is I don't know. And these sorts of inputs for us, we want to focus on things that we can control. We don't control inflation. We don't control policy. We don't control if it's Republicans, Democrats, conservatives, liberals, what Putin's doing, et cetera, et cetera, et cetera. So we choose to focus on things that we can control, which is namely identifying, as I mentioned, high quality, predictable companies, owning them in our portfolios and sort of keeping an eye in terms of are they continuing to meet the factors and primers, at least on a financial perspective, that led us to owning them in the first place. But I do read a lot of macro stuff, and I do find it very interesting, and I do have opinions on all of this stuff. Productivity, correct me if I'm wrong, but productivity has been dropping fairly steadily in developed countries for better part of 3 decades now, I think. And I'm not sure if you guys are familiar with Dr. Lacey Hunt at Hoisington, but he and a few others, not many, in my opinion, have gotten so to me, this all comes down to interest rates. When we talk about, inflation, deflation, really we're talking about interest rates. And of course, interest rates is the single biggest input in terms of computing the present value of a cash flow stream, be it a bond, a stock, piece of real estate, or what have you. So from where I sit, because we also do have some allocation to fixed income, I think what we're talking about here, we could be talking about inflation, but we're also still really talking about interest rates too. I think that is an important and interesting discussion. And, we've seen interest rates since 1982. Many people have been calling the bond bull market, for the end of this. Ever since I started paying attention to this in 2008, the bond bull market was going to end. But it would seem that we've had a 40-year trend in interest rates that's been going down. And in my mind, this has been fairly well explained by the buildup of debt. So Darius talks about how the households in the United States are doing well. Okay. I don't know how well the average household or the below average household in the United States or Canada or Italy or Japan for that matter are doing, because of course, a 10% inflation rate is going to have a disproportionate effect on their ability to buy food, buy gas, et cetera, et cetera. Using anecdotal evidence here in Canada, my base case assumption is that we're already in a recession. In fact, we've been in a recession since, I would say, February. We've had 2 GDP prints in the US that are negative, and now all of a sudden 2 GDP prints that are negative isn't the definition of a recession. So we would change the goalposts. We've had the yield curve that is most inverted now since 1982. And with all due respect, Darius, now people say, well, it's the 3-month and the 10-year, not the 10 and the 2 or the we can pick this apart, but the 10 and 2, I believe, has had either a 96 or 100% predictor of recession in the past. And I don't think this time is different. And I do think we are probably in a recession. And as a long-term focused investor, that excites me because I think that's going to give us some opportunities, which of course that we can discuss here. So when debt, I think it was Rogart and Rogoff, right? They did a study looking at debt to GDP. Once debt to GDP of a country gets beyond 90%, we start to see growth start to slow. And so in my opinion, we are in a boom bust cycle that is aided and abetted by backwards looking Fed policy. They were too slow to raise rates here. They're going to be too slow to lower rate. We're going to get something's going to break, whether it's a recession, whether it's a problem in the credit markets or what have you. And then they go, and we're going to go right back down to 0% again. That's my base case. And we've seen this pattern play out since 2006 now, right? Housing never went down. We don't have a housing bubble. We get 2008. Apparently we did have a housing bubble. They ram rates back down to 0%. 2018, we're on autopilot. We're going to keep raising rates. Market pukes 20%, right back down to 0%. COVID hits, right back down to 0%. So my assumption is, and I do think inflation has peaked, again, just using anecdotal evidence in terms of gas prices, food prices, airline tickets are being discounted, Target's inventory levels, Amazon, all these retailers, their inventory levels are through the roof. They're discounting like crazy. I do think that we're going to see an inflation coming down. So yeah, that's my view on macro. I do see, I wish central banks, honestly, I wish central banks didn't exist. I wish we could allow the free market to determine the price.
It makes four of us, I'm guessing.
having a monopoly over the price and quantity of money, to me, is criminal. I just don't understand how this setup happened in the first place and how everybody still is okay with central banks. My personal opinion is that they do more harm than good. I just assume that they're going to be late to the party to lower rates again. And it seems to be on repeat, which becomes really interesting for somebody like Darius. I don't want to say it becomes easier for you, but I mean, this might be a question I'd put to you, Darius. Does it become easier when we have a sort of financial assets that are so dependent on Fed policy? Because to me, it seems like we just keep seeing these patterns repeat themselves. And if I were a macro focused investor, I think it might be easier than in the past where, the Fed wasn't, I mean, I know they're not supposed to care about the stock market and they're not supposed to care about what politicians say and think, but their actions suggest otherwise. And their actions seem to be a function of human nature, which, as we know, doesn't really change. So yeah, that's where I come from on a macro perspective. Just to your question, Mike, in terms of the management teams that we're talking to, ability to attract and retain labor is probably top of the list in terms of their challenges, whether it's a consulting company in Norway we own or, a tech company in Israel. They're all saying the same thing. So I would agree from a bottom up perspective, we're seeing that as well.
Yeah, that's sort of the point, is that, as much as the purists in the stock picking Graham and Dodd type of approach, call it with a little Buffett growth on there, and moat would be claiming that you're insulated. You're not insulated. There's wage cost pressures. They're going to be pushed through all economic entities and corporate operators. And I'm assuming your approach is to have that margin of safety and whatnot, but it's just interesting to hear from you as you are interacting at ground zero or at the bottom level of the corporate interface, whether the top down side of things is actually congruent, which it sounds like it is. That has implications, as you've already alluded to. There's the discounted cash flow rate on expected earnings, but expected earnings are a function of the inputs to create the earnings. I think this also longer term creates a lot of automation, creates a lot of opportunity for everything from robotics to AI checkouts, where we're going to be removing humans from the base rates of those interactions with technology in order to cope with some of this. That may be a slightly
I think we could all agree that,
but
it's only a matter of time before the Fed murders the economy.
Guaranteed.
Right? But the question is,
Sure.
when does that happen? How does it happen? What does it do to the economy? What does it do to, how does this unfold? How does the economy,
I would actually push back on that.
Yeah, go ahead.
To be honest with you. Yeah. So, no, again, I'll be very clear in saying our base case scenario is for something that looks like a near recession. I don't know that. And JC, you brought this up. The 10s threes yield curve is actually the one that does have the perfect hit rate. And that's the one that Campbell Harvey wrote his paper on back in the mid 80s. The 10s twos is the one that CNBC focuses on because it inverts more frequently and it's much more of a thing to sell people.
And
but
they were just on. They were just on with Meb Faber just a few days ago. The latest Meb Faber podcast covered.
Yeah, and who was
with Campbell Harvey and Rob Arnott.
Arnott, absolutely. So the fact that it hasn't inverted, and it typically has a 12 to 18 month lead time in a recession, tells you that a recession should not at this particular juncture be your modal outcome, unless of course this time is different.
But didn't we just have GDP prints that were negative?
That's fine. You had a technical recession. What we're talking about is an actual recession where you see a drawdown in total employment, drawdown in income, drawdown in the various capex, all these different sectors of the economy. And an NBER recession was what I'm sort of alluding to.
Yeah, but right now we're just talking about demand destruction, right?
Yeah,
or at least an outlook for
economy that on the production side has had two negative prints, but that are mostly driven by sort of inventory swings. we've certainly, if you look at gross domestic income, we're still growing. In fact, we're accelerating in terms of gross domestic income. And and in terms of how the NBER dates recessions, they look at the average of gross domestic income and gross domestic product. And right now, the average of those two is an economy that is still technically growing, albeit modestly. So we're however you want to slice and dice it, we are not in an actual recession. We might have had a technical recession, depending on how the third revision of Q2 GDP shakes out, but it certainly has not. I mean, if you look at the labor, just look at the labor market. This is not a drawdown in total employment. Anyway, the one thing I will say is the pushing back on your point, Pierre. I don't know that the Fed tightening to a state that causes a recession is the modal outcome yet. And the reason I say that is, again, this is an economy that has a significantly higher degree of sort of juice of growth, of nominal growth potential. Right now the Fed's policy rate is at 2.5%. They said that was neutral back in 2018 when inflation was 3% and real growth was peaking out at 3%, on a year-over-year rate of change basis. We're talking about levels, orders of magnitude of that at this particular juncture. So I would, and again, I don't think the Goldilocks soft landing is the modal outcome, but certainly when you look at the most recent inflation data, which we just talked about, that's on slide 80 here. Actually, let me share my screen again. My apologies. When you're talking about the breakdown in inflation that we just saw, if we stay at these rates of breakdown, so we saw a 460 basis point breakdown in trim mean CPI inflation on a month-over-month annualized rate of change basis. That's here. We said 247 basis point of median inflation. Again, this is median inflation, everything in the time series. Yep. Sticky inflation, 270 basis points. These are the kinds of breakdowns in inflation as indicated by this bottom panel in these charts that almost never happen outside of recession. And so to me, there is something happening here in terms of the easing of supply chain conditions, et cetera, that's causing some significant degree of inflation shock to the downside in the same way that we saw in inflation shock to the upside. Now, going back to the point I made earlier, it's very likely, at least according to our secular inflation model, which is a pretty sophisticated dynamic factor model that is designed to project the trend mean of inflation. According to that model, we're going to settle out at around, kind of the midpoint of the estimate is around 2.5% for core PCE, which is, basically a 90 basis points higher than what it trended at in the prior decade. That's a meaningful move. I mean, if we're talking about a Fed that's trying to get us back to 2 on headline inflation in terms of headline PCE, and it's going to get stuck at, let's call it 3.5, that's a big problem because that is a Fed in that scenario that's going to tighten us into a slowdown. But to me, I don't know that we're there yet. I think this is something we're going to have to learn based on what appears to be transitory factors coming out of the time series. Once we're having this conversation 3 or 4 months from now, and we've got a chance to look around and see, okay, we're done with the transitory coming out. Where are we now? Then I think we can have a discussion about whether the Fed tightens us to a well beyond restrictive policy setting that causes a recession, an actual recession.
Do you think anecdotally? Sorry, go ahead, Jason.
I was just going to say, when rates go from 8 to 10%, that's a 25% increase. When rates go from 1 to 4, so the Fed rate's at 2.5%, but nobody's borrowing at 2.5%, right? You're getting a line of credit at 4 or 5, or I think your mortgage rates in the States are like 6 or 7%. So we've had a near 200 to maybe even arguably 300% increase in interest rates. How that doesn't break something, I mean, I would love to think that it doesn't, but the last 3, 4, 5 rate rising cycles, we got a recession. So I don't know how this rate rising cycle, we don't get a recession, especially when rates were basically pinned to 0 for so long. And again, we've seen this movie before from 2009 to 2018, prior to 2000. People do stupid things when money's cheap and free. Mm-hmm. There's a misallocation of capital. I don't know how we get through this without some serious pain, be it in the stock market, real estate market. I mean, real estate market is 13% of the Canadian economy right now. The real estate market, for all intents and purposes, is dead in Canada. And it's basically
beyond dead in the U.S. We're contracting at minus 60% in terms of housing starts and building permits. On a 3-month annualized basis. Like, it is beyond dead.
What percent does that selling real estate, buying real estate, mortgages, what percent of that is the U.S. economy? In Canada, I believe it's 13%. Sorry?
It's less than 4%. Yeah, it's not
Canada's
as meaningful as it was. Yeah. Right. I'm not, the base case scenario is the economy is going to slow. I think we're sort of arguing two sides of the same coin here. The Fed does have a poor track record at engineering soft landings, but the one thing that's that's working in their favor in this particular juncture is the fact that we have not seen the kind of capital misallocation in this cycle that you have historically seen heading into recession. I mean, this is the growth rate of financial sector leverage heading into the GFC, obviously, trending at a +2 sigma growth rate on a trailing 5-year Z-score basis into the GFC. Now, that's very clearly not the dynamic that we have today. Same thing with, that's the household sector. This is financial sector here. And so it's very clearly not the dynamic we have today. The one sector of the economy where I am concerned about, misallocation of capital is in fact the corporate sector. We do have the kind of leverage growth in the corporate sector that would historically sort of perpetuate, a much more, kind of deleveraging process, a much more significant deleveraging process that could result and wind up in a recession. So I think the debate and the jury is still very much out, which is, again, going back to that yield curve chart. There's a reason why the 10s-2s is inverted and 10s-3 months is not inverted, because it is a legitimate debate whether or not we should be having a recession. If you look at consumer expectations, those are one of leading indicators for recessions right now. If you look at the spread between consumer confidence expectations and the real life conditions on the ground in terms of present situation, we're in the second percentile of how negative this spread is currently. So it's telling you that there, if you think about this from the lens of this debate we're having right now, the leading indicators are saying we're going into a bad place. But the conditions on the ground are telling you that things are kind of fine. We're in a booming economy. And so it's can inflation decelerate fast enough to not allow the Fed to get their policy rate into a restrictive territory will determine whether or not we actually wind up in a recession.
You think,
so how would you,
go ahead.
Sorry, just one quick question, Darius. How would you think about the fact that consumer balance sheets are great and consumer expectations are in the toilet? Those seem to be at odds to me.
Yeah, I mean, they are at odds, but I mean, at the end of the day, what drives consumer spending is the red line. What drives the sort of, forward-looking kind of estimation on whether or not the cycle's peaking to roll over is the blue line. But right now, if you look at consumer spending, it's actually hanging in there. What slide is that? Sorry, I got way too many slides in this deck. Here we go. Yeah, consumer spending at 0.6% on a 3-month annualized basis. It's nothing to write home about, but it's certainly not the kind of, doomsday scenario you would have expected to see given the 9% inflation on your screen and all the stories about, the low income consumer being left for dead. The reality is we're still technically growing on a real basis in terms of consumer spending. And I don't think the average investor realizes that. I think there is something to be said about how strong this economy it is. In rate of change terms, it's obviously delta negative and will remain delta negative for an extended period of time. It's just, I'm not so sure that a recession is the modal outcome. And if the recession is the modal outcome, we got to have a very different discussion as market participants, because one thing I know for sure is that we have not priced in a recession, not even come close to pricing in a recession.
So Darius, I also want to come back to something that you're mentioning over and over again, which is the modal outcome. And not this time you shared slides, but the previous time you shared slides, if you could bring those slides up, and it was the longer term inflation volatility side of things. Those were the charts that you were showing. Just not this set, just the previous set of slides, because there's something there that it was sort of longer term. It had sort of the inflation around volatility. That was one chart.
In the previous deck or in this deck?
I didn't want to jump in because there was a flow of conversation. No, in this deck. But just as you shared the last, it was the time before you shared. So you shared right here and then stopped sharing and shared. Yeah. Yes. I think these are yes. So I want to point out something here that is interesting, and it speaks to two items. One is, what is a modal outcome? So the modal outcome is the average, so to speak. So we're trying to think of what is the point estimate here. What's so, I think, incredibly underestimated at this point is that the dispersion around that modal outcome is incredibly wide vis-a-vis history. Okay. So if we think about inflation volatility and think about its connection to real economic output that Darius outlined much earlier in this conversation, the thing that we have to consider is that our distribution of outcomes is probably 2 or 3 times wider than it's been in quite some time because of these inflationary output issues. So I don't know if you guys have read A.H.L. Mann's Ice and Fire paper, just talking about inflation volatility. So inflation volatility, this is the volatility around, so the dispersion around the average inflation rate prior to 1990 was about 5.4%. I might be slightly off in the numbers because I'm going from memory. From 1990 to today, it's about 1.8 or 1.9%. Right? So you have this inflation volatility input, which directly inputs real economic output, as Darius mentioned, that is usually 3 times as wide as it's been since 1990. The impact of which is this very
100%.
conversation that we're having, right? It's this very conversation that you're saying, Jason, but I see this stuff and I think about this in the context of the last 30 or 40 years, and this is the outcome. It is quite different. The fact that we have inflation is one thing. The fact that we have such little insight, or the fact that our estimates are now so much wider than they've ever been, is a real challenge, and it needs to be reflected in asset prices. It's not just the discount rate on those cash flow assets. It's the uncertainty around the discount rate that, again, amplifies the discount that we have to get today for assets that we buy to get better returns in the future. And so I just want to, like, there's some nuance here that's just incredibly important. And I know, Darius, you're talking about that mode, that mean, that sort of average, and they're all slightly different definitions. I am aware of my stats class, but they speak to this. Yes, we're targeting this middle outcome, but we have to absolutely respect that the range of outcomes is much wider than it's ever been. So I just want to, so this is why this is such a contentious issue.
I'll step in and take the opposite side of that and suggest that this isn't important at all. And the reason that it's not important is if you're allocating capital with the view of a 10, 20, 30-year time horizon, and you say to me, are we going to have higher inflation? I'll say yes. Are we going to have lower inflation? I'll say yes. We're going to have higher rates, lower rates, different people in political office. Yep, all of it. Yes. Will we have wars over the next 10 years? Yep. All of that is true. The one thing that is interesting that I had my eyes open to in sort of the last 6 months, and I don't know if you guys have, you may have read some of Buffett's annual letters, but I'd really encourage you to read the 1983 letter that he wrote. And he goes through a very interesting example where he highlights the difference between the generally accepted narrative that one wants to favor hard assets, tangible assets in an inflationary environment as the best hedge to hedge against inflation. And he uses the example and compares a oil co, so a CapEx heavy company that's exploring oil, versus a asset light, intangible asset company such as See's Candy. So your asset heavy commodity producer in an inflationary environment, let's all agree that the price of what they're going to sell goes up. Oil, copper, gold, coal, whatever. But if your CapEx to sales is, let's say, 10% or 20% or something like that, your CapEx is also going to go up. To your point, Mike, if we've got a tight labor market, labor costs are going up and margins may go down. So these commodity companies, they don't control the price they could be the best run oil and gas company in the world. And at the end of the day, they're going to get whatever the spot price is for oil or gas. And he compares this with See's Candy. See's Candy's intangible asset, of course, is their brand. And I think Berkshire bought See's Candy for 20 or 30 or $40 million. And they've extracted over $1.2 billion of free cash flow from this business because that business doesn't require a lot of capital to maintain their operations and grow their operations. So all of this is to say, whether we get sticky inflation, higher inflation, low inflation, in our opinion, the best business model, whether it's high inflation, lower inflation, really any type of environment, is one that has high gross margins, has asset-light business model. So their CapEx to sales, let's say, are less than 5%. They don't carry a lot of debt. We typically see companies that don't have a lot of debt. They're able to increase their market share and be on their front foot in a recessionary environment than those who are saddled with a lot of debt. And they possess an intangible asset, whether it's IP, whether it's a brand, whether it's We own Rightmove in the UK, which is the MLS equivalent in Canada, the MLS equivalent in the UK. And it's a website. And I mean, we could argue it's worth nothing. But 80% of people who are clicking onto the internet in the UK go to Rightmove to look for a house to buy or sell or rent. The classifieds business typically is a sort of a winner take all business model. So in that context, at least this is what we focus on. We are looking for companies that can consistently and have consistently grown their earnings. And if their earnings growth rate over the past has been 15 or 20%, and going forward, it's going to be now 10% because of, some of the input costs have gone up, as you noted. We think that that's where, our best efforts are spent, because the reality is, I mean, we could pull everybody on this call. We could pull all the listeners, say, okay, where's inflation in 6 months? Where are interest rates in 6 months? Where's oil in 6 months? We might have a few that are right. You have to sort of consistently be right on the macro front, in my opinion, because inherently it's market timing. It's
Well, now we're going to have a conversation.
Oh, you've really done it.
Because
now.
value investing is market timing as well. Warren Buffett's two largest investments this past year, Chevron and Occidental. So I get the idea conceptually of looking for high profit margins. That's fine. Using 83, Buffett story, I don't know. I mean, Warren Buffett sits on his high horse and talks about how crypto is going to destroy the world, while silently he is funding Nubank, a digital bank out of Brazil. So, you get your trigger when you talk about Warren Buffett is the grandpa that does a bunch of stuff because
$90 billion.
Is two-faced. And he didn't get it through value investing. He did it through the structure of his insurance company, the leverage he employed, and doing it. So all good, right? Maybe we put that aside in a little bit of a. I'm triggered. I'm triggered.
Jason, you bring up a good point. Like you're absolutely right. If you're going to do macro well, you need to have a systematic process that is more right than wrong over a consistent period of time. I don't think that is any different than being being a bottom up stock picker, right? If you're, if you bought Yahoo instead of Google in 2000, if your screen told you to buy Yahoo in 2000 instead of Google, you'd be having a very different career, right? So I think at the end of the day, you need to be good at what you're doing to have good, superior results. I think that's kind of the key takeaway of this discussion. But Mike, to your point, it's not, I don't think that there's any one discipline that allows you to make money in financial markets, nor is there any one discipline outside of stupidity and disregarding data that causes you to lose money, right? Like there's a bunch of ways to be right and a bunch of ways to be wrong. But I think the key takeaway from this conversation that I'm getting is that, to your point, Mike, the distribution of outcomes is as wide as we've seen in a long time. And I think it goes back to the fact that inflation is high, inflation begets more volatility, more economic volatility. Therefore, the outcomes are wide. And oh, by the way, we have a very different Fed reaction function than the one we're all used to from the past, let's call it 12 to 20 years. So I think that's, I think we have to be aware and humble and honest about the range of outcomes as investors. We need to be humble. I don't know that buying company A or company B or buying security or factor A or factor B is going to work 3 to 5 years from now in this new regime.
I love this, like Jason's coming from the infrared side of the spectrum, and Darius and Mike are more or less coming from the ultraviolet end of the spectrum. And somewhere in the middle, we're gonna meet at the green, at the balance of green in the middle of the spectrum, where we can maybe agree on a couple of things by the end of this conversation. Yeah.
Well, it's really interesting to think through, looking at the macro lens and then thinking through the micro lens. What are the makeup, Jason, of some of the companies that you're seeing that have these, high margins that you feel will be protected through wage inflation? And we have seen some value investors start to make significant capital contributions to the sector of energy. So, I have no say in that really. I just observe it casually and I say, okay, that's interesting. But what are you seeing in your portfolio? Is there anything that you're seeing that's manifesting? Because if you're managing a tight sort of 15 to 20 stock portfolio where you're looking for those high margins, Are there any sort of sector biases that you're seeing in the portfolio? And then how do you correct for those sector biases? Like, do you have to sort of say, well, I'll take 2 or 3 companies from this really favored sector and then start looking further afield? How do you manage that scenario in your portfolio management framework, given that macro to this particular style of investing is a bit of a, it's a bit of a third wheel. It's not something that you're constantly considering. But I also wonder, what are the insights that you're gleaning from what you're doing every day from bottom up?
That's a good question. So, as I mentioned, we are looking for companies that are generating strong and predictable returns on invested capital. There's a company that we're looking at.
Predictable. I understand what strong means. What do you mean when you say predictable?
Well, if you have
low variance in the time series, or
basically, yeah. Or steadily increasing as opposed to steadily going down. Gotcha. I'm just thinking out loud here. There's a company we're looking at, Fever Tree. So Fever Tree produces the premium tonic that I've heard.
It's delicious, by the way. Endorse.
True. It's true. Not true.
I am some of that. I'm some of that profit margin, 100%
in the States and Canada. So they went public at something like a pound. They shot up to 40 pounds, and now they're down to about 8 pounds. They're trading at, I think, 25 times earnings. This is a very strong brand. It's a premium brand. It's a global brand. It has #1 market share in every single country that they operate in, but for one. Anyone want to take a stab at what country that is? No?
US, UK.
It's actually Germany. US. It's Germany. So Germany has a very, and I didn't know this, a very strong history in terms of producing tonic. So they're not #1 in Germany. So this is a dominant brand. This is as far as we're concerned, a beautiful business. It is fairly asset light. Their margins have been very nice, but their gross margins have come down. And this is what has led the stock price to drop 75%. In our view, it's still a little bit overvalued. We want it below 20 times earnings, to meet that 20% hurdle rate, which is, a real big hurdle for us to get over. But why are their margins down? So their margins are down because glass is more expensive. And so most of part of the premium of Fever Tree is that they offer their product in a glass bottle as opposed to an aluminum can. So glass prices have gone up. Shipping prices have gone up. So up until very recently, they've just opened their own production facility in the US, but typically all of the stuff was produced in the UK, and that it had to get to the US or it had to get to Italy and so on and so forth. So where we look at this, we say, okay, are these, and we're always generally asking these questions. Are these short-term problems? Is this a short-term glitch, or is this a problem that is going to have a long-term implication on our estimate of fair value or intrinsic value, if you want to call it that? So we do think that shipping prices will come down. In fact, they have come down quite a bit. We do think that the increase in shipping prices because of supply chain, COVID, all this stuff, we do think COVID is a short-term thing. I mean, it's taken 3 years and it's still ongoing, but I do think we get to a point where COVID becomes a distant memory, although maybe not, because the average flu that we get is apparently a derivative of the 1918 Spanish flu, but that's a whole nother hour and a half or 2 hours. But generally, when we're finding high-quality, predictable businesses trading for less than 20 times earnings, there's usually some sort of glitch. And that glitch, where we spend most of our time, is trying to determine if this is a short-term glitch or a long-term glitch. So does Fever Tree get back? So all the while, by the way, their revenues have been increasing by like 25%. The company, if anything, has problems meeting the demand. And again, we think that is a short-term issue. Some of the other companies that we own A2 Milk in Australia. Their 50% of their business is providing infant formula to the Chinese market. And most of that was actually being provided through what they call the Daigou channel, where Chinese people would go to Australia, fill up their suitcases. I didn't even know this existed, but fill up their suitcases with products from Australia, New Zealand, and take them back to China and sell them and help fund their vacation. Of course, when COVID hit, that channel just went to zero. So they had a lot of problems. And again, do we think that is a short-term problem or a long-term problem? So, and then maybe this gets us into a sort of a macro discussion. Do we think inflation is here forever? Do we need to adjust our models because margins are getting compressed. It sounds like Darius is of a similar opinion to me, is that inflation has peaked and it's likely to come down. I think it probably goes lower than 2.5% as his model suggests. But regardless of 0% or 2.5% or 3%, it's likely to come down from these levels. And so again, we feel that this is a short-term issue. We want to use transitory or whenever. And short-term could be 6 months, could be 3 years when it comes to COVID. But again, when we're focused on what does this business look like in 10 or 20 years, 6 months or 3 years is by definition short-term. So we're seeing it for sure. But I think the biggest thing that we've seen is the types of companies that we own. So I guess you would call us growth investors with a very strong value discipline. Is that the discount rate for discounting these cash flows has doubled. You double the discount rate, the asset drops 50%. We haven't quite seen all growth stocks drop 50%, but we have, for example, we've seen the free cash flow yield in our portfolio go from 5% to 8%. Just as an example, I think that's a tremendous amount of value the average growth rate for the past 3 years of our weighted, we call it Hillside Co. Weighted Hillside Co. is 22%. The average return on equity, 63%, debt to equity, 0.5. We think our basket of businesses is, if anything, relatively undervalued right now. That's how we approach things.
It's actually,
yeah.
And I like that. I do see, this is where I get into the sort of whole market timing thing. A value investor looking for growth is market timing based on a different set of criteria than price. So you will reduce your positions when their prices are high. You'll increase the positions when you feel you're getting that margin of safety and those returns to the portfolio. So when we're active managers, it is hard to get away from having some modem of discerning price and its fairness, and then timing that. So this is where, I get triggered by certain things, but I absolutely accept that this is a worthwhile investment endeavor in approach when it's done in a disciplined nature, but it does have evolving exposures. It does have evolving exposures per market set. I also wonder, so last year when you were having challenges finding these value businesses, did you have sort of a higher cash position generally?
We did, yeah. So our sell discipline, to your point, is that we will sell something if the fair value becomes greater than 2 times our estimate. So we assign a conviction level to all of the stocks that we own or we're interested in: low, medium, high. Low is 3% weight, medium is a 5% weight, high is a 10% weight. So if a 3% weight becomes a 6%, so if it goes 2x on weighting or 2x on valuation, we will trim. So, we're selling things like Rationale. Rationale is they produce the all-in-one steamers and cookers that you might see in restaurants or catering, and they're out of Germany. They're trading at 55 times earnings. They told us long-term they think they can increase their earnings at high single digits, low double digits. That's very, very expensive. We were raising cash, not because of any other reason than we were executing our sell discipline. On the buy side, you're right. We have a 20% hurdle rate. We hope that short-term annoyed investors will sell down something to a level where we're going to buy. But it's not market timing in terms of, we're following a macro signal in terms of, of inflation or interest rates or politics or any of this type of stuff in terms of how to allocate capital.
It strikes me that
you're following a macro indicator, which is the corporate profitability of
I was going to say, it does strike me that you are making inflation forecasts. You said, for instance, the tonic producer, you're saying the glass isn't going to be high. That to me is a very direct macro view. I don't have an ability to forecast glass prices, but it's clear that is obviously an input. And so I'm certainly not coming at the process. What I was trying to elaborate the conversation in the same way that Mike is doing is making sure that everyone realizes, all the listeners, that you are always making a macro bet. whether you acknowledge it implicitly and attack it ferociously with the data-driven process or not, doesn't mean you're not making a macro view. You're making a macro view that, hey, XYZ problem is short-term and is going to go away. That is a macro view.
Sure. I mean, the macro view we're making is that we think that the way to generate and build wealth over time is to be a business owner, not a lender to a business, not own rocks or commodities, let's say. So we think that the path to, we are investing for the retail investor in Canada. People, generally people have retirement goals. We think that the best chance of success of achieving those retirement goals is to own high quality, predictable businesses, regardless of the macro backdrop. When we're making little changes at the margins, sure. When we're talking about cash that we had back in 2021, we had 5% cash. We think that, the evidence strongly suggests that one wants to be an owner of businesses and one wants to have the majority of their capital allocated to those endeavors, regardless of, let's say, the macro backdrop.
Yeah, I agree with that. Definitely.
Darius, why don't you talk about your macro outlook now? And let's see, let's see if we can have a meeting of the minds.
Yeah, absolutely. So let me start by saying, Jason, that was very helpful, by the way.
Yeah.
I don't get enough company pitches. So actually just the meeting I had, client meeting I had just before this meeting, they're probably some of the longest term growth investors in the world. You all know who they are. I'm certainly not going to name their names, but you definitely know who they are. The reason they talk to me is not because they need me to tell them what businesses to go invest in. I mean, they're all traveling around the world, meeting with management teams, et cetera, et cetera. They know what businesses to invest in. The reason they meet with me is on risk management and portfolio construction. Do I want to have XYZ% in a Mexican cement company or, Dutch glass making company? Or is that not necessarily a good time to be allocating to this particular style of risk? Maybe I have a smaller percentage position, or maybe I have a smaller conviction in this new idea, or maybe this is an opportune time to take profits in XYZ a set of securities. I mean, one big call we made last year was, helping investors get out of kind of the higher beta side of growth. We saw the writing on the wall and the tightening liquidity conditions and help them. They had done really well for an extended period of time on the higher beta side of tech growth, the Cathie Wood type names, and they booked a considerable amount of profits last year. Kind of as a function of our research view. Had nothing to do with, the companies themselves. It's just a function of, hey, we're getting into a different macro regime. So just on that front, I do think there's a meeting of the minds in terms of risk management, because again, that's what we're trying to do is help investors with risk management. I think at the end of the day, you can forget more on the way to the bathroom about company A, B, or C. But anyway, just on Pierre, on the macro view, I'll be really quick in terms of our outlook, just in terms of, and Mike, you hit on this. It's actually really funny you said this. I was circling this while you were talking, but in terms of the medium-term outlook, the distribution of probable outcomes is flat and wide as it's been in recent years. This is literally on our key takeaway slide. We do this a presentation every month for our subscribers and supplement it every week, every Saturday. So the one thing I'll say is just in terms of the modal outcome from the perspective of that distribution, we are transitioning into what we call deflation. That's where growth and inflation are trending lower. Negative deltas on growth, negative deltas on inflation. And historically speaking, based on, about as careful back tests as I've seen on this side of the table and in the industry, based on the back tests, between different asset classes, different sectors, style factors, et cetera, you're going to want to have a defensive lean in your portfolio, whether it be through style factor risk, low beta, dividends, quality, all the kind of stuff that Jason would, probably favor at a reasonable price, would be the kind of things that you want to be allocated to in your portfolio. Inexpensive, high beta, cyclicals, value, small caps. In fact, a lot of places where a lot of investors crowded into in the first 6 months of the year. And so that kind of, just it's sort of the same way with the fixed income markets as well. And so one thing we do for our subscribers and for our audience, 42 Macro is take all the forward-looking views that we have on the economy and relate them specifically back to portfolio construction through the lens of, expected returns, volatility, covariance, and percent positive ratios. And ultimately, we help them sort of transition their portfolios from state A, which is where has the world been in the prior regime, including, different factors such as, Fed tightening its policy rate, balance sheet reduction, fiscal policy tightening, et cetera. What's the speed of the magnitude of the change in growth and inflation? To where's the world going to be, at least according to our forecast. Now, obviously, with any process, there's going to be forecast error, but obviously, there's, generally speaking, there's less forecast error than there are accurate forecasts. So, we understand that, hey, we're going from this setup, which favors, these kinds of sectors and style factors and disfavors those kinds of sectors and style factors, to this setup here, which favors these kind of sectors and style factors at the expense of those things here. And what we're showing here on the x-axis in these diagrams is the volatility covariance rankings as a measure of risk, and on the y-axis is a % positive ratio and expected returns as a measure of reward. And so we're doing this across asset classes, different industries, different other asset classes. And ultimately what we're trying to do is help investors think about the world from a portfolio construction perspective based on everything we think we can know about growth, inflation, and the Fed's reaction function to all that stuff. Will we be right? Most of the time, yes. There's some times, obviously, when economic volatility is as high as it's been, we're going to have forecast error. But as I said, we're one of the few people that I'm aware of that are actually making money on a year to date and year over year basis. And so I think the process is certainly doing what it's supposed to do, which is help investors minimize drawdown risk.
And I think that's obviously incredibly important, as we've talked about, for whether you're funding retirement, endowment, pension plans. That drawdown risk is a very real volatility boogeyman, if you will. You lose 20, you got to make back 30 to be break even. I think we all know sort of the math behind those types of things, and that consistency of return does allow for more flexibility at the asset user.
Absolutely.
Place position. So it's a more conservative environment. Don't be out there taking a whole bunch of risks at the moment. Monitor and measure that risk, which I think, Jason's process also does just inherently, probably always. I mean, that starts there. What can change your view, or do we need to go through that deflationary sort of scenario in order to set up the next growth scenario? What, you talked a little bit about, I can't remember if we did this before or after, sort of this soft landing-ish. So what do you have your eyes trained on, Darius, the moment that will give you that sort of tilting either way, whether we're going to come out of this with a softish landing or it's going to be a little harder? What are the kind of the key takeaways there that you are keenly observing for
that's a great question. So to me, it's the number 1, 2, 3 answer to that question is, where does inflation momentum stall out? As I mentioned, in the month of July, we saw a significant deterioration in inflation momentum. That was obviously positive for asset markets, positive for the economy as well. And, are we going to go back to levels like, that we trended at pre-COVID that is consistent with the Fed's inflation mandate? Or are we going to stall out somewhere closer to 3 to 4% in a lot of these metrics? And if we stall out at 3 to 4% in these kind of metrics, then what's going to happen is that we're going to see a pretty significant drag on net liquidity. Whether you look at it through the lens of the Fed's balance sheet, the Treasury General Account balance, reverse repo facility balance, all those things are going to take you towards our bear case scenario, because it ultimately means the Fed had its foot on the brake for longer. I think Jay Powell did an excellent job sort of communicating what I thought he should have been communicating, which is, the concept of the Fed pivoting next year and cutting interest rates is not only inconsistent with, what current inflation dynamics would suggest in terms of the outlook for inflation, but also it's very inconsistent with historical inflation episodes and inflation fighting regimes, not just in the US, but also abroad. Typically you're talking about something that looks, you need to be tight, restrictive for 12, 18 months to really see material kind of degradation in inflation trending momentum. So, as I mentioned, if we do see inflation settle out at levels that are 50, 100, 150 basis points north of levels that are consistent with the Fed's 2% target, they will have their foot on the brake for a much longer period of time, and they will take policy into restrictive. I would argue it's very far from restrictive at this point, as you can just tell by the labor market. Very clearly not, we're not doing much damage to the broader economy. They will take us into restrictive, and we will have a downturn that is not priced in. So I think we need a couple more inflation prints. I think we're having this conversation in October, November. We'll know a lot more on what the likely path forward is.
Do you think anecdotally the Fed was sitting there thinking that the market took the inflation momentum, at zero the wrong way, that they misunderstood it, or that they were worried that the market wasn't getting the signals that the Fed is trying to communicate to the market, that they weren't getting it right? So
yes and no. So we've seen inflation break evens, inflation swap rates. Those have broken down pretty substantially. So the market from that perspective, from the inflation pricing perspective, the market is moving in that direction. This is 2-year inflation swaps. 1 year, 2 year, 5 year, and 10 year. The market is moving in their direction. Now, the problem is, if you look at it from a structure perspective, we're now starting to bottom out at levels that are extremely inconsistent with their price stability mandate. This 2.5% on a 10-year, for instance, is the trailing 3-year average prior to COVID. 2% on a 5-year inflation swap rate. We're talking about 100 basis points more of inflation pricing in. So the improvement we've seen has really stalled out since kind of mid to late July. We saw agriculture prices bottom. We saw industrial metal prices bottom then. And we're now starting to see crude oil prices bottom. Obviously the SPR release, China zero COVID, was weighing on those, the crude oil, the energy markets. But if we start to see energy markets start to behave in the same way that we've seen agriculture and industrial metals prices, then I think the bear case scenario, the probability of the bear case scenario is going to start to rise again at expense of what had become a rising probability of this Goldilocks soft landing. Like I said, we've never seen outside of recession the kind of lapse in inflation momentum we saw in the month of July. So there is something to be said about inflation being transitory. It just, how much of it was transitory.
Right.
And if not enough of it was transitory, then I guess the bear case scenario that will rise in probability terms and also in market pricing terms over the next several quarters. So I think the jury's still out.
Awesome. Any, Jason, any final words on your side of the coin there on the,
No, my best guess is that the central banks will talk tough, raise rates, something will break, and they will pivot. I don't think this time is different. I realize inflation's higher than it has been in previous rate rising cycles, but I think inflation can and will come down quickly. I think that these higher rates are really hurting people and corporations. As I said, it certainly feels like we're in a recession. The GDP prints from where I sit being negative would suggest that we're in a recession. If we're not in one now, we will likely be in one soon. I think that probably sets up the conditions for equity markets to go lower. And I think at that point, that's when you do want to take on more risk and do allocate capital to high quality, predictable businesses that have a strong competitive advantage and history profile of increasing their earnings. At the end of 2021, people were throwing money at companies that had no earnings. Price to sales was used as a valuation metric, which really was interesting.
Yeah,
unbelievable.
That's always a sign.
Yeah.
That's always a sign.
Yeah.
When people start to use price to sales, like, is it 2000 again?
Sales. Exactly. The 2000. It's funny you should mention that because I started in 1998 and a lot of this stuff, I'm like, I've already had these arguments. I've already seen all this stuff before. And it felt a lot like the tech bubble actually. Greedy when others are fearful and all that good stuff. I do think we are going to have a tremendous buying opportunity in front of us in the next number of months. And I think that's somewhat consistent with what Darius is saying. But that, yes, the spectrum of outcomes is certainly very, very wide. And unfortunately, I think that we have risk assets that are being, really priced on based on what central banks are doing and say, even saying, let alone doing. And I find that to be a challenging environment in which to allocate capital. So by default, we generally try and, as I said earlier, we try and spend as little time thinking about these things. But from a personal perspective, I'm very interested in it, and I've really enjoyed this conversation. Those are my thoughts.
Thank you.
All right.
Excellent. See, we found some common ground.
Absolutely.
Okay.
Of course.
Yeah. One last question for you both. What's an interest or a hobby that you could talk about for hours?
Well, For me, it's cold water swimming.
There you
I
go.
watched Wim Hof, a documentary on Wim Hof, who's the Iceman. He's this Dutch hippie guy who's really embraced cold water immersion. We were at our cabin in the pandemic, which is where I am right now, which is literally on the water. You know, March 2020, the water temperature here is about 7 degrees Celsius. And I had always avoided going into cold water as much as possible. And so I just made the decision to rip the Band-Aid off and give it a go. And it's been unbelievable. I love it. I crave it. I have a group that I set up. We go every Thursday morning when I'm in town in Vancouver, rain, snow, sleet. And it is bar none. And from a value perspective, it costs $0. It is bar none. It is bar none the best way to start the day. People ask me, how does it make me feel? It feels like on those days when I immerse myself in cold water that I can accomplish anything because I've just done something that's quite difficult. You get certainly a lift and a bit of a jump in your step. So for anybody that's listening, who's ever wondered what it's like, my 2 guarantees are: 1, you're not going to die, and 2, you're going to feel like $1 million. And I think it's good to challenge yourself and get out of your comfort zone and do things that are a bit difficult. So for me, and this is something that I've kept going even after the pandemic, for me, that would be one of the hobbies that I could talk about for a long time.
That's excellent. I'm laughing because 2 things Black people hate the most are going in water and being cold. Count me out, man.
Well, hold on, Darius. Hold on. I mean, I love this whole, I love Wim Hof. I love the whole cold water immersion thing. But, having played some professional football and some college football for many years of my life, sitting in an ice tub up to here was the only way to survive when you do 2 and 3 day practices. So you talk about squeezing your system and getting that inflammation out of every joint. It works. It works.
Horrible.
It's horrible, but it works. And it's the only time it works.
Just to your point, Mike, sorry, Darius, I play a high level of squash, even still to this day. And I've had every single anti-inflammatory drug that's out there, and cold water does more. The only problem with it is, you almost have to kind of immerse yourself every couple of hours to keep up with it, with the effectiveness of the anti-inflammatories. But yeah, that's one of the other benefits that's just been massive.
Yeah.
And I've got all my squash buddies into it, and yeah, it's fun.
It works, man.
You didn't keep doing it, Darius, after post football? You didn't keep getting, you're like, left that behind.
By far, my least favorite part of training camp was sitting in those ice tubs. Much rather do 2 a days all day. Just give me another drill. So, by the way, great question and great answer, Jason. I love hearing kind of how people kind of spend their time, and because again, this is an industry, as we all know, we spend way too much time in front of the screens, right? Like it's nice to be and unfortunately, answering your question, the nerd that I am, I spent all weekend. My fiance was up in Montreal, on your side of the border, and so I spent all weekend here, just like building and kind of iterating our models. I mean, one thing that we've been talking about in this conversation is the concept that there is more volatility in economic time series. And, one thing that when you're building a model, obviously you have to train it on a certain set of data. And clearly the volatility itself, the realized volatility time series, eventually going to get caught up into the models and into the projections. But I'm not so sure that, to your point, Jason, I think you're pretty confident that we're going to go back to this disinflationary 2% and below world. And I'm not so sure that based on some of these more structural dynamics that has changed, that is the case. You want to have a little bit less auto-regression in your model and stuff like that. So kind of my answer to your question, Pierre, would be, econometric modeling. It's something that I cut my teeth on. I love it. I've read every book on it. I think it's really fascinating. And, because again, I don't think we're trying to, create pinpoint precision. I'd like to be precise and pinpoint and get every single forecast correct. But what we're really trying to do is take everything that we can know and project it into the future so that we can make informed investment decisions on a consistent basis. Because again, I don't, as intelligent as I am, I don't trust myself to say inflation is going to go back to 2 because I believe it. I don't have enough gray hair in my head. I haven't been through enough cycles. I don't think anybody, maybe with the exception of Mr. Buffett himself and his partner, Charlie Munger, can make those kind of assertions without actually doing the work. So that's probably my answer to your question, is just how do we get better at solving this problem that is figuring out what the economy is doing?
Yeah. More screen time. So I've got a question. I'm going to ask the question, and I will refuse an answer, but when you do econometric modeling, how do you handle the linear modeling with the nonlinear outcomes?
Yeah.
But I'm going to save that one. I'm going to get that one to you later. That's one for that we'll start the next time Darius is on. Burrow, that's a good line. I love it.
Castics, baby.
Okay.
Yeah.
Well, guys, thank you both so much. That was
all right.
Very stimulating conversation.
Thank you.
Oh, but let's tell everybody where they can find you. I know we did at the beginning. Let's bookend it so everyone knows where you are. If you got Twitter handles and websites and all that good stuff. Jason, why don't you hit everybody up with all of
Sure,
the
yeah.
list of
I mean, you
stuff
can find me on LinkedIn, Jason Del Vicario. I am on Twitter, but not as active on there. Similarly, just search my name, and the website for our practice is hillsidewealth.ca.
Absolutely. Awesome. Thank you, Jason. And then my name is Darius Dale. I'm the founder and CEO of 42 Macro. We consult. You manage money, we consult you. Biggest institutions in the world, mom and pop retailers, all the way down to you name it. So come check us out at 42 Macro. I'm pretty active on Twitter as well. 42 Macro, D Dale, DDALE is my handle.
Darius, I think I sold you short on the intro.
Oh, no, not at all, man. I
did. I said smaller investors, high net worth individuals and family offices,
no.
but it's actually so much more.
We're in the trillions of clients AUM that we consult and advise on. So we appreciate that.
Thanks for clarifying that. Yeah,
we'll just make peer.
Re-record that.
All right.
Appreciate you. No, thank you.
Thanks
for having us, Jason. Pleasure to meet you, my friend. This is an excellent conversation.
You as well. I enjoyed it. Thanks for having me on.